Good morning. My name is Anna Cuddiford, and thank you so much for taking the time to join us today. We know it's an incredibly busy morning for you. Today, we're going to talk about the recent banking turmoil and what that actually means for investors. With me, in order to discuss some of these issues, are Jim Leaviss, CIO of Public Fixed Income at M&G, and Fabiana Fedeli, who is the CIO of Equities, Multi-Asset and Sustainability. Jim, Fabiana, thank you for joining me. We're now into the third week of banking turmoil, and it's left investors incredibly spooked. We've seen this start with Silicon Bank, which many of us had not even heard of 2 weeks ago. And now, obviously, today we're in the European banks are in the eye of the storm. Now, do we think, I think clients are basically asking, do we think this is a systemic risk? What is it that we ought to be looking at? I would like to start with you, Jim, initially. The market reaction to the UBS takeover of the weekend doesn't really appear to have been taken that well. It was meant to be shoring up of confidence, but can you talk us a little bit through why you think the market isn't reacting as perhaps we would have expected?
Well, I think your point about the question whether this is systemic or whether it's idiosyncratic is the important one. And on the face of it, these are idiosyncratic events, both Silicon Valley Bank and Credit Suisse. But it should be two stories: one an American story, one a European story. But I think it's impossible to completely put them separately now. People are saying, look, the Fed has been aggressively raising interest rates now for over a year. We've had 400 basis points of rate hikes, and when the Fed hikes, historically bad things happen. So I think that is what is going on. If we look at the US situation, look at the European situation, Silicon Valley Bank, top 20 US bank, what was the issue there? It was about its exposure to government bonds, that it hadn't marked to market because it got an exemption, generally because it was a smaller bank than your kind of top four Bank of America, Citigroup type banks. As interest rates went up, the mark to market on those was hidden to some extent. And remember, it had a lot of uninsured depositors who got spooked, tried to take their money away, and then the authorities had to step in to rescue it. So you could say that is very isolated to smaller banks and tech banks without a traditional deposit base. Credit Suisse, on the other hand, is a story of two big losses. Greensill, where I think it lost about $10 billion, and a hedge fund, Archegos, where it lost about $5 billion US, had some deposit flight again. So the story in both cases is one about confidence as a result, in one case about rates going up, but generally about the whole stability of the banking system. And I think we're not going to get away from that anywhere for the foreseeable future. We're going to be nervous about the impact of rising rates, and as a result of that, it probably means that central banks have to take note of that. Because remember, what central banks are trying to do is, of course, they're fighting inflation. In the case of the US, they're also trying to maintain full employment, but all central banks have a role in financial stability as well. And they know that hiking rates into this environment is going to be quite negative for financial stability. And as a result of that, we may get another 25 basis points from the Fed this week, but the markets now have completely changed their view as to what happens to interest rates. So if you went back a couple of weeks, the market said that the Fed was going to get to 5.5% by the end of the year. Now we're talking about 3.5%. So that's a huge 200 basis point difference as a result of SVB, Silicon Valley Bank, and the European banking issues that we're seeing now. So I think a lot has changed. It ought to be idiosyncratic, but the markets are now thinking there's a systemic thing. And this is all about confidence. After all, banking is about confidence. So we can't be complacent here.
Thanks, Jim. And I guess it's also the speed of how things have happened has really sort of taken a lot of investors by surprise. Credit Suisse, even though we knew that they had a lot of issues, was essentially a very, very well capitalized bank. Fabiana, perhaps I can move over to you. How do you see within this backdrop and with what Jim has just explained, the health of some of the actual, from a bottom-up sort of fundamental analysis of some of the banking equity that we look at?
Well, we have all learned a lot from what happened in 2008. So have regulators, and so has the financial system. And if you look at how regulation has been applied to European banks, it is actually applied in a far more reaching way than in the US. So the vast majority of European banks have very strict liquidity rules applied to them based on Basel III. Overall, if you want the health of the system, whether it is in European banks, whether it is in many of emerging markets banks, and whether it is in the largest US banks, is strong, and probably stronger than it has ever been before. But as Jim says, this is not a matter of fundamentals. I mean, for Credit Suisse, it wasn't necessarily about fundamentals. It's really a matter of sentiment and confidence. And it can go a long way, because you can always have a run on deposit, and no bank can really withstand that, no matter how good their liquidity is. So from this point of view, are we in a much stronger financial system that we've had in recent years? Yes, at least in Europe, in emerging markets, and for large US banks. Regional banks are different, and the regulators will have to deal with that. But that doesn't mean that we're totally out of the woods. And so this is one of those times where, as investors, really have to wait and see and make sure that the regulators can instill confidence in markets.
And I guess for both asset classes, we really have to kind of start to weigh up. Have we actually seen a change in capital structures? And Jim, what I'm sort of referring to here is the AT1 bonds that really, I think, is what spooked the market today. Traditionally, we know that they're well ahead of the equity, bond equity holders within the capital structure. Could you perhaps just explain a little bit where we are with that?
Yeah, so let's think about what the capital structure of a bank is. It's basically the ranking of where money goes into the structure and how it gets paid out if something goes wrong, who takes what risk. And generally the safest money the first people to get paid back is usually the tax man in the case of default, but after that it will be insured depositors. In the UK and in Europe, most people are insured up to 85, 100,000 pounds, euros, something around that degree. Also federal deposit insurance in the US, and so the government secures the first lot of deposits. Then there'll be unsecured deposits, and then senior bank bonds, and then there are lots of different rankings of bank bonds. So senior, lower tier 2, tier 1 and CoCos. These are the bonds that we're talking about, AT1 bonds, and then equity, common equity down at the bottom. There are other complications about whereabouts you lend to. There are operating companies, holding companies, so you can find yourself in the wrong bit of a bank or any company if you're not careful as well. And then there are securitized bonds, so it's very, very complicated. But there is a strict ranking, and so with a good lawyer or a good credit analyst, you ought to know where you stand in the event of an entity going bankrupt. And almost always people's assumption was that common equity holders are very last in the queue. They get all the upside when things go right. If the bank or the entity does really well, equity goes up and up and up. Where with a bond, you lend 100 euros, you get 100 euros back in 5 years time, 10 years time, and earn a coupon in the medium term, and that coupon is steady, so it doesn't go up if earnings go up like your equity dividend would be. So you take a lower prospective return for investing in a bond relative to equity, but you take lower risk. In this case, remember, these lower ranked bonds, these CoCos and tier 1s, these were designed to be loss bearing. So they came in after the global financial crisis in order that banks would have capital that would take losses if something went wrong. But there was always an assumption amongst bond investors that they were still more senior, higher ranked in the capital structure than common equity. Now, in this case, the Swiss regulator, in order to get the deal done over the weekend, decided that whilst equity would be take significant hits, those tier one bonds issued by Credit Suisse would be wiped out. So I think it's about 17 or so billion worth of debt has been wiped out to zero, effectively expected to be zero. And yet there is still some value left in the equity. And people are asking what's happened there. Is this a change in the capital ranking? And as a result of that, you look around Europe this morning, tier one bonds in other banks, the other big European banks and indeed global banks. You look at Asian banks, US banks, UK banks, all those tier one bonds are trading off by 5 points, 10 points or so, reflecting expectations that these are less valuable than they were before. Now, there's complications here. This is FINMA, the Swiss regulator. Credit Suisse and UBS are pretty much what it regulates. Some private banks as well, but those are the two big ones. And today, the European regulator came out and said, in particular, common equity instruments are the first ones to absorb losses, and only after their first use would additional tier one bonds be required to be written down. So the European regulator has kind of said, we disagree with what the Swiss have done, and they've said that quite loudly today and in a press release. Whether all plans, whether they survive contact with the enemy, as it were, if that is what would happen in a similar situation, we don't really know. But that has given the market some comfort, I think. So we're not seeing a meltdown in tier one that you might have perhaps thought, because the people are saying this is going to be stock by stock, regulator by regulator, and I think the European regulator has put some underpinning to the tier one market, but still it's going to be a fragile day and fragile sentiment going forwards.
Okay, that was very clear and very helpful. Thank you. Perhaps we can actually move on to talk a little bit more about some of the things that you've touched on inflation, central banks, and what options do they have left? The ECB last week hiked, and they were, that was very, very well telegraphed. We've already seen Lagarde making, the press making comments that Lagarde might have to step back from that a little bit. But the big thing is we're waiting for the Fed on Wednesday. You've mentioned that it's likely that they'll hike by less. But really, we think that, or is this the big experiment post-financial crisis coming to an end? And where are central banks going to be able to help get us out of this if it is systemic?
Yeah, I mean, the lesson since, I guess, Ben Bernanke during the great financial crisis is that central banks will do whatever they can to avoid a rerun of the Great Depression in the 1920s and going into the hyperinflation later on. So they will do whatever it takes, and that if that involves more quantitative easing, if it involves bailing out banking systems again, there is no appetite. Remember, people are exhausted coming out of COVID, going through all manner of banking crises over the last decade and a half. We know the global economy is fragile. We know there's a war in Ukraine, all of these sorts of things. There probably isn't the appetite amongst any policymaker to allow a global banking crisis right now. And if that means that they have to pause from hiking rates from here, or if it means that they have to reopen dollar swap lines as they're doing now to pump liquidity into the global financial system, or Swiss central bank providing 100 billion liquidity line to UBS, all of these things will get done. But remember that it isn't just central banks that set the price of money. It's all banks, it's all financial players, and things like rising bond yields in credit spread terms are effectively a tightening. Even if the Fed does nothing, that's a tightening. People, I think, are most interested in what's going on in those small regional banks in the US, where you've got a big long tail of regional banks outside of the big money center banks that we talked about earlier that provide a lot of banking to Main Street America, that have suddenly realized that they've got big losses on their bond books historically, being helped a bit actually now because bond yields have been falling so aggressively. Some of those losses won't be so great. But suddenly you've got people suggesting actually that monetary policy transmission mechanism will mean that effectively interest rates have gone up by 1.5% over the past 2 weeks. So although the Fed hasn't done anything over the past 2 weeks, the crisis in the US banking system in those regional and mid-sized banks is equivalent, because of their tightening lending standards, to an effective tightening of 1.5%. I wouldn't put too much weight on that number, but certainly we would expect that it'll be far more difficult for companies and individuals to be able to get a loan in America, and that's what monetary policy is. So I think that the optimism of the first quarter of the year about the strength of the US economy, and we saw that in things like very strong jobs market in particular, strong consumer sentiment, strong business sentiment, I'd very much expect that to be tapered down over this quarter. Fabiana, probably come to you on that.
Yeah, I mean, if you look at how equity markets have behaved, even just today, it's so interesting, because equity markets actually liked the ECB and the European regulators coming out and saying, wait a minute, tier one bonds actually should supersede equities. It gives some form of certainty on the capital structure. And so you see that there was a turnaround of European markets on that news. So that degree of confidence, that reassurance that central banks have it under control, that really needs to be there. And it's really interesting also to see how equities have behaved from a sector to sector standpoint. So you've seen, for example, that information technology is up since pre-SVB and Silicon Valley Bank in the US, because there is this expectation that possibly rates are not going to go up as much as initially expected. You've seen actually equities not doing too badly if you take out the banking and the financial sector. So markets are trying to take this in strides, and they seem to be quite rational in seeing where the degree of contagion so far is contained or not contained. But I would agree with Jim that we will understand more when we look at consumer confidence, when we look at the next few steps that central banks are going to make in order to reassure markets.
Great. And we are in this news is very new. It's evolving incredibly fast. How are you both looking at your portfolio construction at the moment in terms of, you've said we've got to wait and see, but at the same time, what is it that you're looking for opportunities, and where do we think investors really should be looking at the next step ahead? Fabiana, if I can start with you, please.
Sure. So we came into 2023 telling our clients that this was likely going to be a year of surprises. So we had to be open-minded to anything that would come from whatever direction. And while at the very start of the year, it did look like fixed income was better poised than equities, should we have a recession anytime soon, at the same time, we felt, if we have better news in terms of macro backdrop, if we have maybe a recession looking less deep than expected, you could expect equities to do better. We had a bit of that, but together with that, we continue to have a lot of volatility, and we do expect to continue to have a lot of volatility. So the way we are positioned here is from a multi-asset standpoint, and I'll let obviously Jim talk more about fixed income, but we are longer duration, particularly on the long end of the US Treasury curve, where we feel there's some level of insurance, some degree of insurance in case we do have a worsening macro backdrop. And at the same time, we have a small underweight on the equity side, and we're playing much more the selection. We're being very tactical in how we invest, taking advantage of any volatility that we see in the market. And when it comes to equities, we're really looking at longer term themes that no matter what happens in the world, we know that capital will have to go towards those themes. Think infrastructure, think about the sustainability ecosystem, and think about technology and innovation. We're still going to use AI. We still want to be at the forefront of innovation. So those remain the mainstays, if you want, of our investments in equities. And at the same time, right now, we're just staying put. There's a time when, as an investor, you just have to look at the market, understand the direction, understand the duration of what you see in front of you. So we're not going in a rush. We're on a rush. We are just waiting and trying to understand the direction that this market is taking. And if at that point is warranted to go in and buy into a market downfall, then we'll be ready to do so. We have left some higher cash balances for it.
And Jim, from the bond portfolio side?
I think the big change we've made over the past few months really is to get overweight duration. So people on my team who have been short duration for years really have now gone long duration. And basically, the value came into government bonds again, having been completely absent for many years. Remember, the US 10-year treasuries got down to 0.5% during COVID, and been in this really valuation period that hasn't looked at all attractive to own government bond risk. And suddenly, I guess Trussonomics onwards, you ended up with bond yields coming up again. So government bonds look good value. You had this big inversion of the yield curve, remember, in the United States that has never been seen. You never see that degree of inversion in the US yield curve without the economy either being in a recession or going into recession within about 2 or 3 quarters. So it's highly likely that the US will experience some sort of recession this year. And as a result of that, the valuations in government bonds make you want to own them again. When it comes to credit, personally, I'm short credit at the moment, underweight credit, but hopefully there'll be a better opportunity to get back in. What we're not seeing is a generalized rise in default. So although there is concern around the banking system, when you look at the underlying fundamentals of corporates at the moment, they look pretty good. And for that reason, it's hard to see that you get a significant spike in corporate default rates over the next couple of years. They seem to have a lot of liquidity and some decent balance sheets, but all bets are off if we get a severe recession. So I just want to be underweight the credit asset class for the time being, but looking to pick some up on any widening. When it comes to currencies, we're overweight the Japanese yen, and that's probably our biggest overweight position. I think fundamentally it looks good, and I've got to say, at times of distress in the global economy, go back to the global financial crisis, the yen is the kind of place everyone runs to hide.
And Fabiana, would that be the case, for example, in Japanese equities? I know they're completely different they're not the safe asset, but where do you see value from a more country perspective within the equity markets?
So interestingly, we're really looking at, we're really being extremely selective. If you look at the MSCI ACWI, for example, overall, the difference in performance from a stock to stock perspective within the same sector is moving up. And for some sectors, such as IT, such as utilities, such as communication services, actually above the average and the median of the last 10 years. So this is to say that selection is key. And so it's difficult to make a generalized call from a country or from a sector perspective at the moment, because within the same country, within the same sector, stocks behave very differently. Having said that, there are countries and sectors where we find more interesting opportunities. And from a country standpoint, Japan is definitely one of them. But it's not based on currency for us. It's really based on the shareholder return improvement that we're seeing. There is a real corporate governance turnaround, which has been shown in increased shareholder returns, increased dividends, increased share buybacks, and also improved overall operational structure of Japanese companies. And that is providing a lot of alpha to investors. Other areas where we find interesting opportunities are in Europe, where we believe that in many areas, companies are still undervalued, particularly if we do not have a deep recession. That's right now not our base case. And from a sector perspective, sectors just, for example, information technology, where innovation is still so key for the way forward. There are a lot of babies that have been thrown out with the bathwater, and those are definitely opportunities.
Great. I'm now going to sort of start. We've had a few questions coming in from the audience. This has been incredibly helpful, but we sort of go back to the more near-term issues that we've been discussing here this morning. In terms of if the Fed does only, hike by 25 bips, Jim, we've had a question in saying almost, impossible to predict with the crystal ball, but what would be the thing that would take the markets by surprise? And, would you expect the markets to react positively, or is that already baked into what investors are expecting?
I think the thing that would take the market by surprise would be a 50 hike, which was the consensus until very, very recently. So I think that they would worry that the Fed wasn't getting it, that they didn't, but I think they will get it. If you look back at policy mistakes that people have made, and maybe that ECB hike that we saw recently of 50 basis points will be looked back in the same light as I don't know if you remember the Trichet rate hikes that we had in the height of the Eurozone crisis. Everyone regards those as a policy mistake now, and I think that maybe those ECB hikes may be regarded in the same light. So I think that 50 from the Fed would be a brave move from them, and that nothing or 25 would be much more likely. A cut from them would also lead the market to be spooked, thinking, what do they know that we don't know? So I think that on the grounds of safety and just making sure that the markets know what they're doing, they need to do nothing, 25 at most, and explain themselves well at the press conference. And again, that's something I think the ECB hasn't done very well recently.
Okay. Well, we're almost coming to a close. Are there any further thoughts that I think that either of you would like to leave investors with? I get the impression that essentially we're seeing that the economy was sluggish, but it was sort of, waiting to see what happens with interest rates and inflation. Economic backdrop for financials was a bit stronger than we during the last financial crisis, but we're spooking the market with the events of the last 3 weeks. But are there any final thoughts that you'd like to leave investors with and our clients?
Well, at my end, you said it very correctly. From a fundamental standpoint, we are actually not at all in a bad position. Like, fundamentals appear to be strong. A lot of companies you've seen also in the last earnings season, yes, has been weak and possibly not as good as expected for some areas, but also not as bad as expected for some other areas. So for equities, it will all depend on what happens ahead with the macro backdrop. Are we going to have a recession? Possibly, yes, but how deep and how far in the future are we going to have it? That is really going to be key. And what is happening now could be either an isolated event, and that will depend on central banks being able to manage it correctly. And I would very much agree with Jim that having a midpoint of 25 basis points probably would be the calming area for the Fed, definitely also for equity markets. But it will really all rest on the shoulders of central banks and regulators to be able to give confidence that this is an isolated event. And possibly we're going to have more issues with smaller lenders or smaller banks going forward. But as long as these are dealt with on a case-by-case basis, I think we can, the market will be able to digest them. If they're not, then that will be a very difficult situation for markets. So we're a bit at a binary point right now.
Yeah, I think, I'm probably, a bond investor, a bit more pessimistic than Fabiana's, view of the world. I think that something has clearly changed in terms of people's thinking about the state of the world, and whether that's central bankers, whether that's investors. There'll be a lot more nervousness across investor cohorts about where they put their money. There'll be a lot more nervousness about whether their bank deposits are safe and things like that. And you will see different types of behavior, whether that's moving out of cash and into short-dated government bonds, or reducing credit risk, or I think that this is probably a changing point in the cycle to some extent, and you wouldn't be surprised to have seen that given the degree of tightening that we've seen from central banks around the world. So, as I said before, when you can look back to the Keeler crisis, Latin American crises, LTCM, Eurozone crises, when central banks hike rates, things break in the economy, and we're probably seeing some of that now. I'm hopeful that we've got the resources and the ammunition, and we know what to do. We've got the playbooks. We've unfortunately been through this too many times in the past 15 years, but that does mean that we're not afraid to do extraordinary things to save the financial system. And I think that makes me happy, but it probably does mean that something has changed, and maybe we're nearer the end of rate hiking cycles than people thought we were.
Amazing. Thank you both, and thank you for our audience. We really appreciate the time that you've been with us. We know it's a busy day, and I will let you get back to looking at the markets, and best of luck, and thank you for all your support. Jim, Fabiana, thanks for your time as well.
Bye.
Thank you.